Meta's latest earnings report tells a really fascinating story. It's like a tale of two completely different companies hiding inside a single stock. And, understanding this split is absolutely the key to solving a major market puzzle.
So, on the surface, Meta's Q3 report looked incredible. I mean, revenue growth hitting a massive 26%? That's fantastic. So why on earth did the market react by punishing the stock, sending it down over 11%? What are we missing here?
And that really is the central question, isn't it? What is Wall Street seeing that the big headline numbers just don't show? So let's dig in and uncover the real story behind this paradox.
To solve this, we really need to do a little bit of financial forensics. We've got to look past the official accounting numbers to find the truth that's kind of hidden in the details.
Okay, so this is the number that spooked everybody. The official reported net income was just $2.71 billion. Now, for a company the size of Meta, that figure seemed alarmingly low, and it just set off alarm bells all across the market.
But here's the thing. That reported profit was totally distorted by a massive, one-time, non-cash tax expense. This wasn't money that actually left the company's bank account. It was a pure accounting entry, like a phantom charge that has absolutely nothing to do with the day-to-day health of the business.
And this chart, well, it shows you the reality. See that tiny little bar on the left? That's the official GAAP profit. That stands for Generally Accepted Accounting Principles, the one that was skewed by that weird tax charge. But once we adjust for it, the real profit is closer to $18.6 billion. And the most important number, the one you really need to see, is all the way on the right. The actual cash the business generated was a staggering $30 billion.
So, our analysis here proves the business isn't just healthy, it's an absolute cash-generating machine. The earnings paradox is solved. The business is thriving. But this only deepens the mystery, right? If the business is so strong, why did the stock fall so hard?
So where is all this cash coming from? Well, the answer is pretty simple. Artificial intelligence. This is what we're calling the reaping phase, where Meta is just harvesting all the rewards of its earlier AI investments. This table just perfectly captures Meta's split personality. On one side, you've got the family of apps, Facebook, Instagram, WhatsApp. It's a profit engine with an incredible 49% operating margin. Then on the other side, you have Reality Labs, which is just burning through over $4 billion in a single quarter.
But look, this isn't just any old growth. It is the highest quality growth you can imagine. Thanks to AI, Meta is showing 14% more ads because its recommendations keep people like you and me engaged longer. And it's charging 10% more for each of those ads because its AI targeting delivers better results for advertisers. So it's winning on both quantity and price. It's just incredible.
And to put all that in perspective, the Advantage Plus AI advertising engine, all by itself, is now a $60 billion a year business. This proves that AI isn't some far-off future promise for Meta. It is the powerhouse driving the company's profits right now, today.
Okay, so now that we've established the incredible strength of the present, let's pivot to what's making investors so nervous. This is the sowing phase, planting the seeds for a very, very expensive future in something called AGI.
The CEO has made it crystal clear. All the profits from today's AI success are being plowed right back into the ground for an even bigger, much longer-term bet. The harvest from today is being used to fund a whole new planting season.
And this is what absolutely terrified Wall Street. It is essentially a blank check for 2026. Capital spending, or CAPEX, that's the money for physical things like servers, will be notably larger than an already massive $70 billion. Operating expenses, or OPEX, the day-to-day running costs, will significantly accelerate. And the goal for all this spending? To build the infrastructure for artificial general intelligence, or AGI.
Let's just be really clear here. This is way more than just a new project. It is a fundamental shift in the company's entire identity. Meta is telling the world it's no longer just a social media company that uses AI, it is now an AGI-first company, period.
So let's bring these two sides together. This is how we can understand the deep disconnects between Meta's stellar results and the market's, frankly, fearful reaction.
Investors look at this whole situation and they see the cash from the proven, profitable ad business being funneled into not one but two massive black holes. First, there's the metaverse, which has already burned tens of billions of dollars. And now there's AGI. This is a massive, scientifically unproven gamble, maybe driven by a fear of missing the next big platform shift, just like they almost missed the big move to mobile years ago.
And this, right here, is the key takeaway. The market wasn't reacting to the last 3 months of incredible performance. It was pricing in the monumental, almost unquantifiable risk of the next 3 years. So how should we even think about a company that is at the exact same time reaping this massive harvest from one field while sowing an incredibly expensive and uncertain crop in another?
Well, the only logical way to analyze Meta today is to use what's called a sum-of-the-parts approach. Essentially, we pretend it's not one company, but two separate entities that are kind of bolted together, and we value each one on its own.
So on one hand, you have the family of apps, which is truly one of the best, most profitable, AI-driven businesses in the entire world. And then on the other hand, you have Reality Labs and this AGI bet, which is basically history's most ambitious and expensive R&D project, a lottery ticket that costs billions of dollars a year just for the privilege of holding it.
And this right here is the fundamental tension at the very heart of Meta's story today. You have an absolutely phenomenal core business that is being weighed down, shackled by the sheer cost and the massive uncertainty of its future ambitions.
Which leaves us with the ultimate question, a question that will define not only Meta's future, but maybe the future of technology itself. Is this massive AI investment laying the groundwork for the next trillion-dollar opportunity, or is it destined to become history's most expensive gamble?